When you start your first business venture, a common piece of advice you will absolutely hear from countless online business gurus is to create an LLC. We're here to tell you that not only does this blanket advice not get you anything for your business, it can sometimes be actively harmful to your money-making endeavor. We're about to walk you through 5 reasons you don't need an LLC for your business. And if you watch till the end, we'll cover one important case where you absolutely should consider an LLC. Reason number 1, you don't need an LLC to write off expenses for taxes. We hear this piece of advice repeated over and over again in many online forums. If you want to write off expenses for your taxes, start an LLC, right? Wrong! Starting an LLC has no effect on your ability to write expenses for your business against your taxes. It has always been permissible under the Internal Revenue Code to operate as what's called a sole proprietorship. In layman's terms, you as an individual person can always just hold out your services, charge customers, categorize business-related expenses, and file income tax returns as a self-employed sole proprietor. This makes sense, right? America has always enshrined the rights of the individual to life, liberty, and pursuit of happiness. Want to know another dirty little secret of the LLC world? Often, people pushing LLC creation scheme are agencies or affiliates who provide LLC setup services. Of course, they want more people to create unnecessary LLCs. Reason number 2, LLCs are expensive to create and maintain. This is very often a majorly overlooked aspect of creating a business entity, particularly an LLC. Although it is incredibly easy to form an LLC in most states, the cost to properly maintain an LLC can quickly mount up and threaten the bottom line of your new business. For example, in California, even if you have no business revenue, you must pay the FTB board $800 per year just to keep your LLC active. Furthermore, depending on choices made when you created your LLC, it can quickly become significantly more expensive for ongoing tax filings when you have an LLC. Many CPAs have per entity or perform pricing structures, and you could feasibly expect to spend more than $1,000 on tax prep with an LLC every year, compared to if you just filed as a wage earner. Reason number 3, you don't need an LLC to eventually sell your business. This is another spurious and somewhat nebulous claim often heard. An LLC strengthens your brand and makes your business more valuable. You know what truly makes your business more valuable? Revenue and profits. Until you have these, your business is not worth anything anyway, so this is really putting the cart before the horse, so to speak. Furthermore, just because you don't have an LLC doesn't mean you can't have one in the future. You can reorganize your business from a sole proprietor into an LLC later if that suits you. Reason number 4, LLCs don't fully protect you from your own actions. Here's a topic that you really want to take some time to legally investigate and, if warranted with your situation, engage a qualified lawyer to interpret the applicable law for where you live and operate. If you look back into the history of how the concept of LLCs was created in the US in 1977, you will see that the main intent of an LLC is to protect an investor, keyword, investor, not owner or operator, from risking more than he or she was willing to risk in a private business. If you think about this from a societal benefit perspective, you will soon see why this might be desirable. Take the example of the stock market. Just because you own shares of Microsoft, that does not make you liable for Microsoft's management infringement of a patent, for example. The only risk you have as a shareholder is that the company could become worthless, and the share price goes to zero through the poor decisions or actions of Microsoft's management and employees. Likewise, with an LLC, the history of the law is focused on providing a shield from personal liability of Joe Schmo, who decides to invest $10,000 in my business, but otherwise has no direct control over the actions of the company. Now, if you're like most new business looking to start an LLC, you're probably a one-man shop where you essentially fulfill all the roles of the business as investor, owner, and operator. That is, the person actually conducting the actions of your business. If that's the case, the LLC does not provide a magical shield that takes away all risk of your wrongdoing. In fact, in many states, the interpretation is clarified that just forming an LLC does not personally protect you from your own tortious, bad acts. This means that, say, you open an online translation business, providing translation services on demand. If you then make some big mistakes in translation that, for example, result in one of your customers being denied a visa to travel to a particular country, just because you have an LLC doesn't mean you're safe from all harm. Should your customer seek compensation for damages, any lawyer worth their salt will immediately identify you as the operator and likely sue both you and the LLC if it comes to that. Furthermore, there are states that do not provide as much liability protection to single-member, sole owner LLCs as they do to multi-members LLCs, providing just that much more credence that the LLC may not be protecting you like you think it does. Reasons number 5. LLCs do not protect you from creditors when you have personally guaranteed loans. We just discussed the possible implications of adverse events regarding your LLC, but what happens for something more commonplace like having difficulty paying back a loan? The concept of an LLC sounds appealing, right? Because you're creating a separate entity from yourself, and hey, if something goes sideways and you can't pay back this huge loan you took out from a bank to start your business, you can just turn off the lights and walk away, right? Again, wrong! What many online business gurus and agencies supporting LLC creation won't tell you is that any bank worth their salt will force you to put a personal guarantee, that means you guaranteeing to pay back the money from a loan, even if you go out of business. When you start an LLC, it has no credit history, no profits or revenue, and likely little or no assets. Banks will then force you to put your own money and credit on the line, even if the business eventually makes no money. So, while technically, yes, an LLC does protect your assets from creditors, very few creditors are going to agree to put you in a credit situation without a personal guarantee anyway. So this point is kind of moot. We've reached the end, but it's not all doom and gloom when it comes to creating LLCs. They are viable structures that certainly have a place for a well-capitalized business that has the financial wherewithal to properly engage legal counsel and maintain the LLC for at least several years. One time when you really should investigate the use of an LLC for your business is when you have risk of bodily harm or property damage to your or others in the operation of your business. Say, for example, you open your own private taxi service to compete with Uber and begin transporting passengers for fees. What happens if one of your employees causes an accident that then injures your passengers or others? Well, really, your first line of defense should be a sound business insurance policy that could help you out in this situation. But let's say if the insurance policy is invalidated or they refuse to pay, then in this situation, you would really want an LLC to dissociate yourself from liabilities of the business that you did not have direct control over. Even then, it is not a surefire technique, and this gets back to properly engaging legal counsel to create and maintain your LLC in a way that actually affords you legal protection in a worst-case scenario like this. If you've enjoyed this video, please hit like and subscribe below for more tax and business-related content.